Hello, and welcome to another episode of IJS Speaks. Today is November 17th, 2020, sometime in the early evening, Eastern Standard Time. So, Asian markets are currently in session. Okay, so looking at the dashboard, one quick note about a change that I noticed in the correlations on the dashboard. And by the way, the dashboard looking at the dollar, gold, U.S. 10-year, S&P, and crude oil. The sentiment that I'm seeing on the dashboard is a risk-on sentiment, first of all. But the change that I have noticed is two things. One, the correlation between the dollar and gold, and the correlation between the 10-year and the dollar. So typically when I look at the safe haven assets or the safety assets versus the risk assets, it typically group the dollar and the U.S. 10-year together for, basically representing liquidity and safe haven, low risk type of deal. And then that would be compared against the S&P, gold, and crude oil, representing the risk asset side of the market. Well, correlations are also important, and as markets evolve, correlations tend to evolve as well. So, over the last few trading sessions, I have noticed that the dollar and gold, which for the longest have been inversely correlated and have been moving with a strong inverse relationship to each other, their correlation is drifting into positive territory. And at the same time, the correlation on the 10-year and the dollar, instead of the two being positively correlated and moving together as safe haven assets, the correlation is drifting negative, and similar to what I saw following the that period of uncertainty about the vote count and the electoral college assignments around the U.S. election, where the 10-year Treasury started trading like a risk asset. I'm seeing that similar price pattern happening again. So I'm looking at now my risk assets being the 10-year Treasury, the S&P, and crude oil, and my safe haven assets as of this trading session is the dollar and gold. Now, with that layout being said, I'm looking at selling pressure in both the dollar and gold, which are the safe haven assets, and simultaneous buying pressure for my risk assets, which would be the 10-year, the S&P, and crude oil. So going into the Wednesday session in Asia, Europe, and the Americas, I do expect to see further weakness in the dollar, also corresponding with weakness in gold prices, and further appreciation in the price of the 10-year, which would push yields lower. I also expect that the S&P 500 equity markets to take a leg higher, and also for crude oil to take a leg higher, or at least have a little bit of support in prices going into the next couple sessions. So that's the first thing I wanted to bring to everyone's attention. Other than that, nothing to report on the trade book. no real opportunities to sell out of, or no real signals yet to sell anything that's on there. The SPY straddle, that's actually that position's down a little bit after the first couple of sessions of trading. But that's really because the price hasn't necessarily moved that much in the SPY or in the S&P. It's been kind of bouncing sideways, and so that depreciation on the spread basically just represents the time value eroding away in the contract. So, well, the time value eroding away on two contracts because I've got both a call and a put. But you got a couple more trading sessions till expiration. Expiration is not until Friday, so again, still looking for a little bit of volatility, one direction or another. Gold didn't really move much in the European and the American session. Coming into this evening, the Asian session, it's looking like it's starting to show a little bit of room for movement to the downside. So we'll see how the options on GLD reprice at 9:30 in the morning when New York opens. Hopefully the price can move and it can get me a bit closer to start liquidating some of these positions as we get closer to the weekend. And then the 10-year, of course, the straddle on the 10-year is doing lovely. Seems like for some reason investors are interested in buying up 10-year Treasury notes, and at the same time they're also interested in buying stocks and energy-based commodities. Oh, and also sitting on corn. Corn has moved actually. I've been looking at corn today. I have a future spread on it, and also being long the front month and short a back month on corn. Well, okay, let me back up. The same approach with the euro. The euro US dollar futures. But for some reason, maybe it's due to market liquidity, maybe it's due to the exchanges that they're priced on, or how the contracts are priced. But long story short, the euro US dollar positions offset each other much closer. So the difference between the two, the spread, has been fluctuating between about down to $2.50 to about up $2.50. Meanwhile, the underlying contracts have been jumping around because the dollar had been moving today. But the actual spread itself, has been fairly stable. Same approach with corn. But there are some maybe liquidity disparities between the front month and out to March 2021. But the spread between the two has actually been appreciating in value while holding on to it, which has been beautiful because it's been adding to the buying power in the account. So, but interestingly enough, if I were to have that same position with the same net outcome, which is buying one and selling the other to offset, but instead I were to sell the front month and buy the future the next expiring contract, that spread would be down right now. So yes, the approach to buy long and short, wait for the move to a major reversal point, sell a profitable contract, and trade the reversal. That, in theory, is an approach that can be taken, but there is room for mispricing and mismatching across the calendar in futures, and I guess it probably is based around liquidity. But depending, so if you can do a pair trading analysis, that would be great, because then you can look at the price action of buying one while selling the other one, which would show you, okay, well, if the price action has been trending higher, then that's a position that would be beneficial to hold on to because of how the prices are naturally unfolding or drifting, versus if you did the pairs analysis and the price action was trending lower, you would be losing money to hold on to the position. So that's it. That's something to keep note of, that when doing long and short positions with futures, calendar spread wise, it's important to if you can, first do a pairs trading analysis to look at how the spread between the two have been trending in recent times, because that would show you whether or not holding that spread in your portfolio would be beneficial or adverse, just simply based on how the two different contracts are being priced relative to each other. So that was interesting. That was something I stumbled upon today, and luckily enough, by accident, the pairs analysis that I did after entering the position confirmed that it would be beneficial to hold the position with that configuration. But I could have easily, set it up in the opposite direction. Same outcome, basically buying one, selling the other. Just that small mispricing, creates an opportunity, I guess, for arbitrage. And again, that effect is multiplied if you start holding multiple contracts. So something to keep in mind, especially when playing with futures contracts, and especially with some of the smaller, less liquid contracts, you do have opportunity for mispricing or liquidity effects on pricing over the calendar. So, but it's an opportunity to sneak a little bit of extra return in your portfolio just for holding onto a position that technically over the long term should hedge out to roughly zero anyway, roughly. So, but other than that, and then the spot currency markets, the New Zealand overnight last night bounced around a little bit. Trailing stop loss was tight. Let it run overnight. Woke up this morning, looked at it, got stopped out. It was profitable, small profit, but it was profitable, which is basically, in my mind, amounts to earning interest on the balance in my Forex account overnight. So, I mean, can't ask for more than, that's more interest than I would earn on deposit anyway. So, can't be mad at that. In the Forex account, I currently have a US dollar, Canadian dollar position. The position is down from when I opened it. It is lining up with the fundamentals of the trade that I'm trading on the derivative side of the portfolio, which is why I'm letting the position run. But from a money management standpoint, I do have my breakers in place to get me out of the position if it really and truly just goes rogue. But I'm watching that overnight. So trade book is roughly the same from where we left it. Markets really haven't done much. Haven't had an opportunity to sell anything yet, but the week is young. Well, not young. We're about halfway there. So we had very low volatility coming into the first half of the trading week. Relatively low volatility coming out of the back half of the last trading week. So going into the back half of this trading week, my expectation is for some kind of volatility to pick up in markets because traders need something to trade. Okay. So on that note, I'll wrap it up. If you have any questions, comments, or concerns, you can email me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And I'll try to either answer your question during the next episode or at least respond to your email by the next episode if possible. Don't hold me to that though, but that's the goal. So until next time, when in doubt, take profits. Happy trading. Capital gains.